Hello, everybody, and welcome to exercise 10-15. We're purchasing a computer with zero interest-bearing debt. So Cardinals Corporation purchased a computer on December 31st for $105,000, paying $30,000 down and agreeing to pay the balance in 5 equal installments of $15,000 payable each December 31st, beginning in 2020. An assumed interest rate of 10% is implicit in the purchase price. So let's take a look at this a little bit more closely. So the price here is $105,000. How is this being paid for? It's cash of $30,000, and then the installments are $15,000 each times 5, or $75,000. So this is 15,000 times 5, 75. So this totals here of 105,000. The issue is when I go to purchase the equipment, I can't record it at 105. And why is this? Because this is not today's dollars. So what I need to do is I need to bring back those $15,000 payments back to today. So how do I go through and do this? Well, because the $15,000 is being paid each year over a period of 5 years, I could do each one using present value of $1, or because the amount is the same, I can use the present value of an ordinary annuity of $1. So what I'm going to do is opt for the latter. Okay, and let's see what we get here. Chegg is coming through big time today, and they're giving me this for free. Woo! Okay, so let's go over here. So present value of an ordinary annuity of $1. Okay, so the number of periods is 5, and this is going to be at 10%. Okay. So right over here, this is going to be 5 periods at 10%, or 3.79079. So the value of this today is going to be 15,000, and this is going to be 3.79079, or a total here of 56,861. And this is, again, what I do for the present value of an ordinary annuity. I'm taking $1 amount, and I'm multiplying this by this is going to be present value of an ordinary annuity of $1. This is going to be 5 periods at 10%. Now, I'm going to show you this once because I may have done this before, but I know that some of you have not had the present value of $1 tables or gone through this, so I'm going to go through this with you. If I go back over here to the present value of $1 table, and I'm just going to show you this, how to do this once. So present value of $1, right? So so the first 15,000 is being paid 1 year from now. To bring this back to today, I need 0.90909. Okay, so this here is the present value factor. So that's 1. Okay. If I then go through, and we'll go through and do it on each one of these. I'm just going to move this down here for a second because I won't want to compare that value. Then for this one, this would be present value of $1, 2 periods at 10%. And we'll say this is year 1 payment, year 2, year 3, year 4, and year 5. Okay. This would be present value of $1, 3 periods at 10%, present value of $1, 4 periods at 10%, and then you get present value of $1, 5 periods at 10%. So why am I doing this? I'll show you in a moment. It's got a huge payoff. Okay, so this is 0.82645. I'm going to turn myself into a pickle at the end of this. It's going to be great. 0.75131, and this is going to be to get out of family counseling or family therapy. Okay, and if you don't know what that's from, you're clearly not watching enough of Pickle Rick. And I get point or Solinia, 0.68301. And then I have over here 0.62092. When I multiply each of these over here by the present value factor, what I then do is I total all these up. And when I total these up, I get 56,862. Magically, and this is the huge payoff, right? I didn't turn myself into a pickle. Right over here, you get the same value. So if you are given one of these problems, what you always want to remember is that if the payment stream is the same, I'm going to take one of the payments, multiply it by the annuity table, and that's going to tell me my present value of this right over here. So the value of these $15,000 payments is going to be a total of 56,862. So the way I'm going to go through and record this is I'm going to have, okay, I know I'm paying cash for this equipment. I'm paying cash of a total of $30,000 down. I'm also going to have a note payable for 75,000. But when it comes to recording the equipment, the value of this equipment is going to be $56,862 plus the cash paid of 30,000. So the value of my equipment that I'm going to be recording is going to be 86,862. So this is right here. So now when I come over here, I've got a problem. My problem is my total debits do not equal my total credits. So the difference between these two here is going to be my discount on notes payable. Okay. So this is going to be the initial entry. And now I need to figure out what happens in 2020 and 2021. Well, what's really good is I purchased this on December 31st. So this was on 12/31. So I don't have to deal with any kind of partial periods. So now let's go over here to 12/31/20. Okay, let's do the easy part first. Okay, I know that I'm going to be debiting notes payable for 15,000, and I'm going to be crediting cash for 15,000. However, what I need to deal with now are the interest payments. So my note payable value, or my carrying value of my note payable. So as of year one, this would be 75,000. This is prior to the payment, less my discount on notes payable. My discount on note payable was over here at 18,138. So my note payable carrying value is going to be 56,862. This is very important because the carrying value is going to help me determine my interest expense. So the assumed interest rate is 10%. So right over here, my interest rate is going to be full year. So the amount of my interest expense is going to be $5,686. Okay. Okay, so this is going to be 5,686. So what happens now? Well, I need to record interest expense of 5,686, and then I'm going to credit my discount on notes payable for 5,686. Okay, so before we go any further, let's take a look at what's going to happen after we make these payments. Well, if I come over to my notes payable, it had a balance of 75,000. So my year one payment of 15,000 leaves me an ending balance of 60,000. Okay. My discount on notes payable started with a debit balance of 18,138. And over here, I'm crediting this by 5,686, or the amount that's going to be going over here to interest expense. So my ending balance in the discount is going to be 12,452. So my new note payable carrying value is 47,548. And to do this for year two, I'm now going through here and multiplying that through. The reason why the interest is falling, because as I'm making these progress payments, the amount of the principal amount as well, the principal amount is starting to decline. So my 12/31/21 entry would be right over here as a debit to note payable 15,000, 15,000. But then over here for my interest expense, 4755. So that's what I would be showing over here. Let's just go through and do this through all the years, because I want to make sure that this goes down to 0 at the very, very end. So over here, so this is 3730.03. So this is now going to be amortized by okay. And when we get to that very last year, we see that this amount of the interest is the same amount as the discount. So when this final payment is made, and you would basically see this 15,000 is going to go away, and then the discount is amortized down to 0, because that's what has to happen when we go through and do the note. So that's how we go through and employ the effective interest method as we're going through and doing these this particular problem. Obviously, present value can't underplay the importance of it. The only thing I can tell you is that if this is not making sense, I would go and watch the videos that I have on bonds, especially because that's how we go through and run it. So that's what I would share with you. I want to thank you for joining me here today, and I look forward to seeing you on the next video. Have a great one.